Channel, guys. This is my free trade portfolio. I'm assuming, let's call this episode 1 because this is my first finance video. So I've started a new stock portfolio, and I thought it'd be cool if I just build it with the channel as I go. So if you do like this video, so if you're 2 minutes in or 5 minutes in or at the end of the video and you like the video, please give it a thumbs up and please subscribe as well, because I have a lot more content coming in. Now, I started this portfolio about 3 weeks ago. I thought I'd give myself a little bit of time before I shared what I am doing and what I'm planning to do going forward with my stock portfolio. So my plan is to build this portfolio with you guys. So every week I'll be adding funds into my portfolio, so probably between £100 or £150. And obviously if there's a really good opportunity, I'll add a sort of a larger sum. So far I've put £2,500 into my portfolio, and I thought what would be cool today is to go through every single investment that I've made and give you sort of a short rationale as to why I've picked each stock. So it's likely that there will be 3 reasons for why I've decided to invest in any of these companies. One would be for a growth stock, so a stock that I think will grow pretty well over the weeks, months, and possibly even years. I'm also looking at stocks that give good dividends, because you always want to get an immediate return on your money, whether that's every month or every quarter. And obviously, during this time, stocks have been undervalued. So I'm really looking to invest in stocks that I think are undervalued. So it could be a stock that's been around for 10 or 15 years that I think can definitely do well after the whole pandemic is over. So those are the 3 reasons why I would have invested into some of the stocks I'm going to share with you today. So it's either a growth stock, a good dividend payer, or an undervalued stock. So let's go with my first one, Aston Martin. Now this would definitely go into the category of undervalued stock. It's AMLs, also called fancy cars. I definitely think Aston Martin's undervalued. As you can see, let's go back October 2018, it was trading around £12 to £13, and now it's at 54p. I think I bought my first stock at 35p, if I'm not mistaken, and this is my largest holding. So I mean, today wasn't its greatest day, it's down 2.2%, but overall on the stock I'm up 28.66%, which is an £84 profit. Now, this is a stock I think I'll be buying into slowly, depending on how quickly the stock price decides to rise or fall. And you can see here my average buy-in price is actually 41p. So you can see my earliest stock, I bought 22 shares on the 26th of May, and I believe that's for around 35p a share. So you can see it's 54p, and I've obviously done quite well so far. So my next biggest stock is Spotify. Now, I bought Spotify at quite a high price. As you can see, they've been literally trending upwards for a very, very long time, and I think I bought near the top. Now, I bought Spotify because I believe it's one of the growth stocks, and I think in the next 2 to 3 years, this will skyrocket. As you can see, it's been a pretty consistent stock. It's been up and down, but I definitely think the upward trajectory is where it's gonna sort of end up long term. Music is changing, audio is changing, the way consumers engage with new content is changing, and I believe Spotify is the audio version of YouTube. I really believe it's going to be massive. I think we all heard about the Joe Rogan investment that Spotify made in terms of taking over the channel and owning that, getting Joe Rogan to be part of the Spotify family and platform, and that was a big move and a good move. Personally, I think it's going to add a lot of value long term, and if I can just swipe up, I will be able to show you how well or how unwell I'm doing. So you can see I'm down 2.62% on this stock. However, I don't really mind on this one. I believe this will go quite far. You can see the great thing about the FreeTrade portfolio is the fact that you can buy fractional shares. So you can see on the 28th of May, I bought 0.355 shares, which is good. Good. The next one is the Fraser Group, also known as Sports Direct. This one, I definitely believe they were undervalued. Sports Direct is a really good company. If you look a year back, you can see there was a major fall between the 20th of Feb and what's that date, the 31st of March. They were trading at, look here, £4, almost £5 at one point last year, and now they're down to £2.87 to roughly £3.10. The Fraser Group, there's a number of reasons why I wanted to invest in the Fraser Group. Fitness, people, I don't see gyms opening for a long time, so people will be putting themselves out there and doing a lot of outdoor fitness. And when you're looking for new gym stuff, new gym equipment, new trainers, shorts, any type of fitness equipment, Sports Direct is probably the one of the number one places to go outside of JD Sports. And if you're looking for true fitness, Sports Direct is probably the number one out there. And they offer good value clothing. The Fraser Group also have stores like Flannels, which is a really high-end store that sells a lot of the high-end brands. And what we all know right now is that during the pandemic, a lot of people have lost out, but the people who are rich and do well off, they're still doing quite well. So I can always see Flannels doing very well for the Fraser Group. Evan Cycle is part of the Fraser Group. Like I said, outdoor exercise, cycling. People don't want to catch public transport as much as they did in the past. So people want to cycle into work, walk into work. And Evan Cycles is perfect for them to buy their new bike. So I can definitely see them having great sales over the next few months, weeks, and possibly even years. Now, one of the major reasons why I wanted to invest in the Fraser Group is because of Game. The Fraser Group own Game, and later on this year, they will have the launch of the new gaming consoles. So you've got the PS5 coming out, and we've also got the Xbox. They will be absolutely huge for the hardware sector and the gaming sector. And Game are probably one of the most trusted websites and stores for people to buy gaming products. And in terms of the size of the amount of consoles that will be given to Game, because PS5 and Xbox will sell out, Game will get a high proportion. And I see the amount of revenue that Game take in will be astronomical. It will bring so much more traffic to their websites. It will bring so many more users to the Game. I think it's game.co.uk if I'm not mistaken. And I can see their revenue shooting. So that's another reason why I went into the Fraser Group despite all of the issues. And if you go down, you can see I'm up 10% on this stock, which is a profit of £21. I'm just happy this is going in the right direction early on. My next share is Sainsburys. Now, this one has been a very up and down Sainsburys stock. I actually invested in Sainsburys via CFD, contract for difference. That's something I'll probably explain to you guys later on, and made a decent amount of money when the stock was rising exponentially. Now, Sainsburys is a good stock for me because during this whole pandemic, a lot more people have been spending a lot more time at home, a lot less time buying food and buying takeaway, which also means that they have to buy food from their local supermarket or their major supermarket. And Sainsbury's is one of those places that tend to have slightly higher margins than some of the other major supermarkets and have a great presence within the UK. Now, there was a slight downside, and that was the fact that Sainsbury's also own Argos, and Argos depend heavily on their in-store purchases. And whilst they have a great online store, their in-store purchases account for a lot of their revenue. And since a lot of shops have been closed, that has, put a little bit of a dent in the amount of revenue they can make. However, I think once the Argos stores open back up, they're going to see that revenue pour back in. And due to the fact that a lot of people will be at home, I see that people will be buying things from Argos because it's probably one of the number one destinations to get bits and pieces that fit within the home. So whether it's a new TV, so electronics, or it's a new table or something for the baby, say for instance, Argos kind of has it all. So it is a good stock to be in. The price has been up and down, so it's been a very frantic stock, as you can see here. I mean, they've had highs of £2.34, and you can see lows of £1.79. I bought in at, I think, a decent price, roughly £1.85, and you can see here £1.87 is my average share. And you can see here I'm up 3.5%. So, I didn't expect to be up straight away and this quickly, but it's always a positive to be up. Although they did cancel their dividends, I think they'll reinstate their dividends by the end of the year or early next year. And I think, the amount of revenue they'll bring in will be one of the reasons why they'll bring back the dividends quite quickly. Now, my next share is UK Dividends. This is an iShares fund, and I think this is just self-explanatory. Like I said earlier, I'm looking for stocks that have high dividend yields, and this is one of them. And the great thing is I'm up 4% on this one. Now, the next one, almost, would I say it's controversial? Maybe not. So, Royal Bank of Scotland. Now, I definitely think they're undervalued. As you can see here, they've had a steep drop from £2.50, and now they're sitting at £1.15. Now, we all know the history behind the Royal Bank of Scotland / NatWest Group. I definitely think they're undervalued. I don't think the banking sector will be hit as hard as some individuals think. And as you know, during the time of Mark Carney, he put very strict rules in terms of how much capital the banks have to hold for liquidity reasons, and how banks will be able to react in times of another sort of situation where the banking system is under pressure, and the banking system are very, very liquid, and I just think these share prices are very undervalued. And the great thing is I'm up 8.93% on this stock, so it's always good to be up. I'm really happy that I'm up on this stock, and I think I'm gonna see double digits very, very soon. I've got 100 shares in RBS, so pretty chuffed about that one. The next stock is BT, British Telecom. Now, BT is a strong company. They've been going for years and years and years. Obviously, British Telecom. Now, one of the reasons why I bought this stock is because, one, I definitely think they're undervalued based on, you can see the share price here. I don't think they will be hit as hard as people think due to the pandemic, and it's a great time for me to buy in. What I'm also, really excited about is the fact that the whole rollout of 5G will be profit boosting for telecoms companies such as BT, and people are going to be relying on home broadband a lot more. So people are going to be upgrading their broadband for faster speeds, and based on the fact that they're going to be working from home a lot more often. So even for people who didn't have internet before, internet is now a priority, to have a solid internet connection at home. A lot of people may just tether because they don't use their computers at home as often, and they may be out on the weekends. But now it's really important for a solid internet connection, a solid Wi-Fi connection, and great broadband speeds. And I think BT can offer that. And I think in the coming months we'll see the value that BT will bring to the market in terms of their stock price going up. So next one is Glencore. Now, this is another stock that I believe is undervalued, and if I just go back, you can see I'm 2.2% up on this stock, which is great. They've sort of had a really turbulent few months. You can see the squiggles here. It's literally been up and down, up and down. People are finding it hard to sort of value this stock, but as you can see, they were hit very hard by the recent pandemic, and I think Glencore's a strong company. I'm not going to go too much into detail now, because it is a sort of a finance and a commodities company, and that's something that I'll talk a lot more about in future videos. So the next stock is Lloyds. Lloyds, I can't say TSB because it's actually just called Lloyds Banking Group. It's another stock that's very, very popular on the FreeTrade platform. As you can see there, they were hit heavily by the recent pandemic, and similar to RBS, they will be affected from a revenue perspective in terms of loans and bad loans that they have out there and people not being able to repay their loans. But there has been a lot of government intervention, and I don't think the banks will be hit as hard as people think. And like I said, the UK banks are very liquid, so when it comes to cash reserves and being stable, they definitely are, and that's all due to the 2008 financial crisis, where after that the Bank of England made sure that banks won't suffer as much as they suffered in the past, and that they're very, very liquid. So Lloyds Bank is another one that I decided to invest in. Now Vodafone are very similar to the reasons I invested into BT. It's another stock that I'm up 4.5%, so really happy about that. I think they're gonna do very, very well based on 5G being rolled out soon. As you can see, they dropped heavily because of the pandemic, and they're slowly starting to rise. So for me, it's a really good time to get into some of these stocks because they're really undervalued, because of the shock, people sold their shares very, very quickly, and a lot of people lost out on their shares, and that allowed the opportunity for other people to get in at prices where they were unable to get in the past. And we've got a lot of data to look out here from 2015, and they've never been so low. And yeah, I really don't think the pandemic will be as bad as some people think and some investors think. And as you can see, the bounce back is starting to take place, and the returns are starting to take place. So this is one that I'm very interested in long term. Now Aviva, I actually only invested in Aviva recently, so I didn't invest in Aviva straight away. Now, as you can see, another company that took a massive dip in February. Now Aviva, known for their insurance, and obviously there might be a few payouts due to the whole pandemic, but what I've also noticed is that they specialize heavily in the motoring industry, and due to the fact that a lot of people have been at home, a lot less people have been driving their cars, and if less people are driving their cars, that means less accidents. If there's less accidents, there's less payouts. So they're going to hold on to a lot of the revenue they've generated, and I don't think they'll be hit as hard. They haven't recovered as well as some of the other stocks. But that just means, it's more of an opportunity for people to jump in, and you can see, they've lost maybe 40 to 50% of their value. And I definitely think it's a great time to get into Aviva. As you can see, I'm not necessarily up. I'm down 5% on the shares that I bought, but I'm still hopeful. A lot of these shares are being held long term. In the past, Aviva have given out really great dividends, and that's something that I'm expecting from Aviva long term. So I'm not worried about this share whatsoever. BP, I predominantly bought this share for their dividends. BP always pay out great dividends. I wouldn't necessarily say they're undervalued due to the fact that, oil companies are very volatile and it's dictated a lot by the current oil price, and due to the inactivity of the, countries around the world, oil prices will be low. But I think BP will actually recover a lot. They have a lot of money in the bank, although they do have a lot of debt. They have enough to service that debt and enough to pay out dividends to their shareholders. So I think this is a strong stock to get into. Next one, ASOS. Now, I have to be honest, guys. A lot of the times when I do buy shares, I buy them based on a lot of research and a lot of looking into companies. And I have to be honest here, guys. I invested in ASOS on the back of how well how well Boohoo have done recently, and their online sales have been astronomical. And due to the fact that ASOS are an online store and I haven't seen the bounce back as quickly as Boohoo, I thought it would be a great time to get into ASOS. As you can see, I'm up 5% on the shares, and they took a heavy hit. At one point they were £35 and now they've got back to £30. And I think ASOS will continue to be a strong company. Online fashion is still doing really, really well. As people are spending a lot more time at home, they feel more comfortable ordering from online stores because they know they'll be home to receive their delivery. Some people are not comfortable ordering deliveries to work, and some people who go out to work don't necessarily work in an office where they can always receive their packages. So, a lot of people will feel more comfortable shopping on ASOS, especially if they're not going into the city to work, or they're not really going out much on the weekend. They're only spending time locally. To buy a lot of the clothing that they want, they're going to have to do it online. And I think ASOS are going to benefit quite a lot during this period, and I think long term. So my next biggest stock is Superdry. Superdry, wow, what can I say about Superdry? They were, doing excellent years ago. How far can I go back? So yeah, you can see 2017, their stock was at £19. Superdry is a really good company. I wouldn't say recently, but they've recently taken back their old owner, and he's now driving the ship for Superdry. And I think we will see a comeback with Superdry. The current CEO, I have a lot of faith in him. I think he knows exactly what he's doing. He knows what he wants for Superdry, and due to online sales going up and people are spending money on clothing, I think this is just one to watch. As you can see, I'm up on this stock as well, 3.74%. I believe it was slightly higher before, but maybe I bought back in at a higher price. But yeah, this is one that I'm really happy about. Oh, let's look at this one. Amigo Holdings, actually. I mean, they do give loans. I'm down 21%. Now, I have to be honest with you guys on this one as well. This one was more of a gamble. I've really looked into Amigo Holdings and sort of their whole portfolio, and they have 700 million pounds worth of loans out there. And the way Amigo Loans are set up is that there's always going to be a guarantor, so they're always likely to get their money back even if the original loan taker defaults on the loan, which makes it a pretty strong and robust company, especially with their high interest rates. Now, me personally, I don't believe in Amigo Holdings as a company overall, and 9 times out of 10, I tend to not to invest in companies that I don't believe in. So I'm actually even surprised that I decided to go into Amigo Holdings. But I thought it was such a great opportunity, and I see a lot of potential in Amigo Holdings. And, maybe I should have stuck to my guns, stuck to my principles in terms of only go for companies that you really believe in. But to be honest, I see a lot of value in this. Although I am 21% down, I am not that worried, and I do believe the stock will rally again. You can only see in August 2019 it's at £1.60. So, if it does get to that £1.60 point, that will be great in terms of growth in the stock. I bought at 24p, which was obviously too high. I think the original rally was near £100. You can now see it's at £77. So, we'll see. I'm definitely not going to cut this loan short. Cut this loan, goodness me, cut this short, cut this stock short. This is going to be a long-term holding, and I'm literally going to wait until I double, triple, or even quadruple my money in this one, because I do think it's a stock that's going to grow significantly. Virgin Money. Now, I'm up 0.83% on this one, and it's similar to the other banking stocks where I think it's just another stock that's been undervalued due to the whole pandemic. You can see how much they've dropped. And I think it's full.co.uk literally this evening put out a buy signal for this stock. So I'm really happy that I hold this stock. I haven't got that much invested in it. You can see the total value is £76. But I'm up, and something someone always told me is that, you can't go broke whilst your stocks are up. So as long as my stocks stay up and stay in positive, I don't need to worry. So if it hovers around the plus or plus 1% for quite a long time, I don't mind, because long term, I think Virgin Money will do very, very well. So this one's pretty self-explanatory as well. Footsie All World dividend. This is just another dividend stock that I wanted to invest in for the simple facts of dividends. I think when I bought into the stock, they were slightly undervalued, and I think I'll get a lot of stock growth from this one, and I'll be looking forward to the dividends. I'm up on this one 1%. The next one is Dixon Carphone Warehouse. Now, I wouldn't say I believed in this company as much as some of the other stocks that I believed in. The great thing is I'm up on this one as well, up 6%, which is always a bonus. I believe in the Dixon part of the business, not necessarily the Carphone Warehouse part of the business. I believe a lot more people are going direct to their network provider, whether it's EE, Vodafone, O2, Virgin, Free. Goodness me, I don't know if there are any more out there. And a lot less people are going into stores and speaking to Carphone Warehouse to get their latest phone. However, I do see Dixon being a major player in terms of revenue and sales, due to the fact that because people will be at home a lot more and a lot more often, people will be buying big ticket items. Although, there has been a lot of loss of jobs at the moment, people are going to want their own laptops. People are going to want to have a new TV. People will want new audio and stereo equipment at their home, just due to the fact that they will be spending more time at home. And also, this is another reason, the release of the Xbox and the PS5 by the end of the year, this year, that is going to mean a massive amount of revenue for Dixon's, and a lot of people will be going to Currys/PC World to buy all of this equipment. So I think Dixon will be in a strong position. They have done pretty decent over the years. They're not a struggling company. They've got really high turnover, and I think this is one for the future. Definitely undervalued in my books, and I expect a lot of growth for this one. Knack, always a really good stock to get into. Very, very strong brand. They've done a lot of collaborations recently, which has helped their sort of order book in terms of sales. As I said earlier, a lot of people will be doing a lot of exercise, so they're going to need, the new running bottoms, new trainers, new running socks. All of these bits and pieces will add up to a lot of revenue. And when you're thinking of sports gear, Nike is the number one place people go. So this definitely fits my fitness agenda in terms of stock growths in the near future. Rightmove. Now, cheeky. I bought into Rightmove because Rightmove was initially one of my free stocks. Now, I know the Rightmove company very, very well. What I do think is, I'm actually really happy I bought these shares, because what I do think is people will be moving home, and I don't see house prices necessarily going up, but I feel like there will be a massive relocation in terms of a lot of people with high-end jobs that work in London will be working from home a lot more often, and they may not feel the need to actually be so close to their workplace, so live so close to their workplace. So, a lot of high earners might be in a 1 or 2 bed flat, and they might think, I need a lot more space. I want my own office. I'm going to be working from home more often, and I need that space. And I'm going to be able to achieve that space by living, slightly outside of the zone 1, 2s and 3s, and maybe even a little bit further. And a lot of people will feel that this is the right time to sell their house, and maybe they can see the housing market going down 10, 20, 30%. So people will need the likes of Rightmove to sell their home. And I think it's going to be a very, very competitive market, because people will not be able to sell their house at the value that they ask for straight away. They might have to take a small reduction of 5 to 10%. So people might want to start selling their homes, and the best place to market your home is on the property website Rightmove. I mean, Rightmove is number 1 in the UK. I think Zoopla is number 2 in the UK, but Rightmove is a great stock to go into. Next stock is Facebook. This is also another one that I bought in a fractional share. As you can see, I bought £52. No, that's my overall holdings. I think I bought roughly £48 to £50 worth of shares. Another stock that I'm up 5.27%, which is really good. Most of my portfolio is in the green, is up. So that's really good news. Facebook has massive potential as a tech company. I bought at right near the high end part of their price, actually. So if you look at this graph, I think I bought roughly at this point. So although I did buy this stock at a sort of high value, you can see I bought the 0.28 shares, so I bought £50 worth of shares. Facebook is a massive tech company, a great advertising business. They're growing year on year. And what is really interesting is Facebook are launching a Facebook shop, which is almost a Amazon / Shopify rival, which means people will be able to sell their stuff a lot easier and sell whatever items they've got to sell a lot easier on the Facebook platform. And I think that's going to add massive growth to an already growing tech giant. So Facebook is one that I'm going to be adding more money into as the weeks and months go by. And yeah, I think there's a lot of potential in Facebook. We're getting near the end now. Last 2 stocks. So diversified gas and oil, small holding in this company, 0.34% up. I can only see oil and gas going up in price, and that means the companies that run that run oil and gas will actually improve in terms of revenue, and that means the stock will only go up. So I bought this, 1 for dividends and 1 for stock portfolio growth. And last but not least, sentiment. Now, gold mining company, what happens during a crisis, during a pandemic, people always buy into gold. So I think their revenues and profits will be significant, and it's a really, really popular stock. Although I did buy near the height of the stock, I think long term this will be a good stock to buy into. I am down, 3.83%, but, it's not the end of the world, and it's something that I'm going to hold on to long term. Now, today I'm not going to go into my watch list. However, that will be something that I'll be going into, further down the journey of my stock portfolio. As you can see, in total, I'm up £106 based on £2,500 investment. And, I can only hope that that will grow. I will be adding more money into the portfolio, but from what I can show you now, this is it. And, if you have any comments or anything you'd like to share or anything you'd like to talk about, or if you have similar shares that I do, please drop a comment, and, I'll be happy to reply to as many comments as possible. But yeah, please look out for me. I will be doing another video next week. And yeah, this is my portfolio, episode 1. Please don't forget to like and subscribe.